Hey guys, how's it going?
Good. How are you?
Good. This is another episode of Make Money Count, doing the thing we love and do best. Hey guys, if you're watching this on YouTube and you enjoyed my cheesy face I just made, then you should give us a thumbs up. I know it's a little annoying, but it helps with those things we call algorithms. How's your coffee?
I knew you were going to say something about it because,
Normally you get mad.
well, producer Matt also likes the Connect cups being used. The problem is that this coffee is so nice and tasty. I guess I could do this.
There you go.
Does that make you happy, Matt, or is that worse?
That's a little better.
Is that acceptable?
This coffee is so tasty and warm that I didn't want it to go to waste. And if I put it in this cold cup, then it wouldn't taste as good.
Yeah.
So,
Should we do a shout out? Where's it from?
Furno Cultura.
Oof.
Yeah.
Also very good sandwiches if you're ever in the area.
Right near our studio on Queen Street West.
Yeah.
In the vibrant Queen Street West. West Queen West.
West
district.
Queen West.
Yeah, West Queen West of Toronto, Ontario. Coming to you live, Marcus and Justin. Justin and Marcus. Managed by producer Matt, who was a little worried about doing the show today because he thought he had COVID. And then I had to explain to him that COVID doesn't exist anymore. We had enough COVID. We gave our economy COVID.
Our economy definitely had COVID,
But
now it's recovering.
Well, the leading indicators might indicate that we're starting to come out of it. But that just means like we still have a little bit more to go down.
Right.
I mean, some of the leading indicators would show that we may be coming out of this. I mean, it's not certain yet, and it's not certain kind of like the depths that we will reach on real estate prices simply because of the impact of high interest rates.
Right.
But as we talk about on this show a lot, a big part of this isn't just how much of a bite higher interest rates are taking out of people's wallets. A big part of it is the psychology of how much longer higher interest rates are going to be around for.
Right.
Right. So if you think about when you're speaking to borrowers that are calling or investors that are calling, the number one kind of concern is, oh my God, interest rates are so high right now. And the number two concern is, how much longer are they going to be this high for?
Right.
And leading indicators help us to judge the kind of
Following indicator?
Yeah, the following indicators are like, it's really not a following indicator, right?
Right.
An indicator is something that
I mean,
tells-
if there's something leading, something's got to follow.
But it's
lagging indicator. I
It's like
suppose,
an indicator light on your car, though, Justin. Like you don't have an indicator like after you merge the lane. You
Right.
indicate before you merge the lane, right?
Right.
Or like a check engine light.
Right.
That doesn't come on. There's not a light that comes on after you're sitting on the side of the road and your engine is blown up. Right? There's only like a check your engine or your oil is low
Right.
or you're running out of gas.
Right.
I feel like you've run out of gas a bunch of times.
Okay, so I did once, and it was at if you're listening from Toronto, I was going eastbound on Lakeshore,
I don't
just
think we
past
need this level of
Princess
specificity.
Gates. There was a gas station close by. That's where I'm getting at.
Okay.
Yeah, so I was near a gas station. Luckily, it could have been bad. Could have been like slasher movie stuff. You know what I mean?
The explanation of that could have been bad. Thanks for cutting them off. Thanks for cutting them off there, Marcus.
The explanation for what we heard was already bad.
So, you just talking about the economy. It's interesting. I was in BC this
Yesterday.
weekend. Yesterday I was in BC. Yeah, so it's a little early for me.
Didn't you just come in this morning?
No, last night.
You were there for 3 days.
No, I know, but I stayed up until 2 a.m. BC time the night I got there. So I just destroyed my internal clock. Anyways, gas there, everything is very expensive. I was glued to realtor.ca while I was walking around the you know what I mean? The city.
You were because you were looking at housing prices?
Yeah. Like I couldn't find a 2-bedroom for less than $1 million.
Whereabouts in BC?
Vancouver.
Right in okay.
Yeah, in Vancouver.
Okay, just I'm like want to figure this out. Gas prices were ridiculous, and you were glued to Realtor.ca.
No, I'm just saying, just in general,
Oh, man.
things are expensive.
You're throwing a lot of info out.
Gas was $2.50 a liter.
Do you have any good food while you're out there?
I did get some octopus, and we took a barbecue down to the lake, and I was grilling octopus like while the sun was going down.
Wow.
It was really nice, actually.
Oh my
yeah,
goodness.
yeah, it was really good.
Are you sure you're not Greek?
No, I'm not.
That's awesome.
No, you can tell by the way I say Greek last names.
Yes.
Yeah.
Papadopoulos.
Papadopoulos.
Yeah.
Yeah, exactly. Anyways, I'm just saying, Ontario. It was.
I don't know what you're saying.
It's expensive.
Listen, before we get going, there's a couple things I wanted to bring up on the yields.
Okay.
So I read this really great article in Barron's. Barron's is like it's a weekly, like when before I became a mortgage broker, I was in investment banking.
Mm-hmm.
I had a cup of coffee in investment banking. Like it didn't last long, but it was kind of right out of university.
Did you get fired or did you quit?
I quit.
Okay.
Shout out Scotia Capital. So I was in investment banking. I was an auto parts analyst, and I wanted to be, like a finance guy.
Mm-hmm.
So I got Barron's. I subscribed to Barron's. I had a subscription. It would come to my house on the weekend. I would read through it to try to get these like morsels of wisdom from experts on what was happening in the economy. And it's a fabulous publication. They got an online presence. The little app I have on my phone. I read this article that was talking about the two kind of very important charts that can show as leading indicators for the U.S. stock market and the kind of U.S. economy overall, because they address two of the really important factors that are impacting the economy right now. One of which is inflation, and the other one is flight to safety. So, Matt, if you want to pull it up, I sent it to you before the show. So this is the 10-year U.S. Treasury. The 10-year tells us, we spoke a little bit about what an inverted bond yield curve is in past episodes. An inverted bond yield curve is just when longer-term bond yields are lower than shorter-term bond yields.
Right.
So the amount of return you receive for placing your money somewhere for a longer period of time is less than the amount of return you receive for placing your money somewhere in a shorter period of time.
Mm-hmm.
That is an illustration of what the market expects will happen in the economy. So it's saying that although we will give you a higher yield for a shorter period of time, we will give you less of a yield for a longer period of time because we anticipate that interest rates will fall after the short period of time passes. So after short term, after in the next 2 years, we're going to see increased interest rates, and then we're going to see lower interest rates.
Right.
So 10-year yield curve, it has had quite a meteoric rise. Kind of, Matt's actually, good job, Matt. You've isolated kind of end of August, beginning of September of 2021. And since that point, where it was at 1.3%, it's shot up to right now where it's today trading at 3.6%. We reached a peak of 4% on that 10-year yield. What we have to think about is every time the Federal Reserve comes out and says, we got to increase interest rates, inflation's a really big problem, we need higher interest rates to combat inflation, the bond market reacts. Mm-hmm. So bond prices fall and bond yields increase, right? A yield is basically how much money you're going to get for holding something. So if you buy a bond at below the price of the bond, so say the bond's $100, if you buy a bond below $100, that difference between the price of the bond as it's set out and the price that you paid for it, that difference goes into the yield, increases your yield.
Right.
So yields move constantly, like by the second. The fact that the 10-year yield hit 4 and is now coming back down says that the market as of now is anticipating that rates aren't going to go much higher than what was previously anticipated in this bond market.
Right.
Although everyone kind of agrees that we're going to continue to see Fed tightening, Bank of Canada tightening, increased interest rates, the market is no longer as uneasy about those interest rates surprising the market. And as such, the yields on the 10-year are coming off a little bit. More importantly, the 2-year yield. So the 2-year yield, there you go. The 2-year yield is higher than the
10-year yield.
Yeah. What does that mean?
Anticipated rates coming back down.
Right. But the 2-year yield's at 4%.
This is what they call an inverted yield curve.
That's right, Matt. Man, producer Matt. So if you look, September of 2021, that 2-year yield curve was like at 20 basis points, and now it's at 4%. That meteoric rise in yields is the market coming to grips with the Fed fighting inflation.
Right.
Right? That is, the market kind of saying like, wow, we need more yield in order to park our money here because inflation is so hot right now, and the anticipation that interest rates are going to keep rising is so scary. But in the last week or so, the 2-year yield has come off. So it's another good sign. That's a leading indicator that, we have a ways to go still, but from the peak 4.35, we're off 20 basis points. That is a significant drop. And hopefully, if inflation readings come in a little lower, and if the Federal Reserve sees that inflation readings are coming in lower, and we don't have to, the market doesn't get scared about big interest rate moves kind of continuing, that this is good. I'm trying to relate all this back to like if you have a mortgage right now in Canada.
Right.
This is good. And then the final piece is the US dollar index. So the Barron's piece basically said the two fundamentals that can be seen as leading indicators for the market right now are the 2-year yield and the US dollar index. US dollar index is how strong the US dollar is.
Right.
And the US dollar, very similar chart if you look at it to the 2-year yield curve.
Right.
This is getting kind of technical, but think of it as the US dollar is the flight to safety, right? If things are looking very strange in the economy, in the world, people want to put their money in US dollars to avoid risk.
Right.
And the strengthening of the US dollar actually hurts US multinational companies, hurts anybody that has to produce something in the United States and then sell it somewhere else, because the price of that good increases because of the strength of the dollar.
Right. Yeah.
So the Barron's article is pretty good. It was just discussing that these two kind of very important leading indicators for the market appear to have peaked. That's yet to be seen. I mean, Federal Reserve could come out, and from what we've been seeing lately, Federal Reserve comes out again and says like, next interest rate hike is 75 basis points, and we need to see further tightening, and we may revise the federal funds rate higher from where they've got it set right now. Then you see these things explode again. You'll see the market tank again.
Right.
And again, the market, generally speaking, is both a leading indicator for what's going to happen in the general economy. It's also a bit of a psychological barometer for people, right? Like, we're so inundated with information about the stock market right now that when people see the stock market is down 4%, 3% in a day, it freezes them up, right? Like It's like, okay, interest rates are going, I don't know where. Asset prices in the general economy are dropping, and I'm sitting on real estate. What am I going to do? People spend less. Like, it's a psychological barometer.
Of course.
I'm going to tell you before I finish, and then you can go into the questions that we're going to have. I listened to this great podcast.
Is it called Make Money Count?
No. No, it's ranked a little higher than Make Ready Count. It was a Joe Rogan podcast with a guy named Mark Andreessen,
right,
who is a venture capitalist, private equity guy, and he had this a very intelligent guy, like early investor in every Facebook, Google, but he had this really good quote, which he referenced from somebody else, And he said, the way you got to think about the stock market is it's like a manic person that shows up every morning to trade,
Mm-hmm.
to buy and sell things from you.
Mm-hmm.
But he's crazy.
Yeah.
And he comes in the morning, and depending on like what he ate the night before, or like what he's looked at, or how he's feeling, or if he got into an argument with his wife, he shows up and he's either in a good mood or a bad mood. And he's willing to buy and sell these stocks, these pieces of these companies from you for whatever he decides. So depending on his mood in that day, he's going to have a high price or a low price. And there's no use in trying to figure out where he is going to have his mindset. More successful investors will always understand what they're willing to pay for something, what they think something is worth, and then once they have that set in their mind, they will buy and sell accordingly.
Mm-hmm.
But it's a fool's errand to try to anticipate what, market guy is up to during the day.
Right. Yeah.
And I like that. I like that quote a lot because it's like, it kind of goes along with the fear greed index that we think about when we think about the markets, right?
Mm-hmm.
The market gets overscared, sells off. The market gets overly bullish and greedy, and it, just starts ratcheting up gains.
Mm-hmm.
And in order to be successful in the market, you need to kind of have your own opinions on what the things that you want in that market are worth.
Right.
Which, very, very complicated, which is why I invest in Connect Mick.
Same. Very much
But
same.
I thought that was a really good kind of way to think about the market, right?
No, I like that.
And obviously, there are fundamentals at play, and the fundamentals are these things that we're talking about, right? Right now, the biggest thing weighing on markets is inflation expectations.
Right.
So the more we can do to highlight the leading indicators of inflation for the people that listen to this podcast or watch this podcast, the better of a job we're doing, I think, in a period of time where there's so much uncertainty. Right?
100%. Yeah. We need to cut through the BS.
Yeah.
That's what we're trying to do.
And the other thing is like critical to this entire conversation is to be unbiased.
Right.
Right. Like Matt put up a clip that was edited from a podcast that we did over a year ago where I said, now's not the time to buy a house.
Right.
And we got a lot of flack for that when that went out, that podcast went out over a year ago, because the market was roaring.
Mm-hmm.
And we came out and said, like, don't buy a place because inflation's coming into the market and interest rates are going to rise. And that is going to affect asset prices.
Right.
So the key, critical piece to this is to maintain an unbiased perspective on things. Like, we cannot be biased by the fact that, we deal with a lot of real estate agents or our clients, at certain times, people would love to tune into a show that reinforces their belief on something.
Right.
Our job is to do the best we can at identifying leading indicators, looking at the market as a whole, and offer our advice on it.
We're like the Switzerland of the market.
Yeah.
Yeah. I like that.
Switzerland.
We're going to take a quick break.
But not the Credit Suisse of the market.
I was about to say the
yeah,
same
yeah.
thing. Ugh.
We're going to take a quick break. And when we come back, Marcus is going to tell us where he got his cool guy jacket.
Be sure to visit MakeMoneyCount.com to find all of our old episodes.
Canada's economy is changing. Mortgage rates are rising. Property values are falling. The equity in your home feels out of reach. Your bank doesn't have the answers for you. Connect.ca helps homeowners borrow for less. Your home loan approved online in seconds. Funded in 24 hours. Then the advice you need to get back on track. The money you need, the answers you need, when it matters most. I'm Marcus from Connect. Let's make money count. we're back.
And we're back.
And we're back.
And we're back.
Can you hear me?
I can hear you. Can
Hello?
you hear me? Marcus does this to me all the time, where he'll call me and he'll pretend like I can't hear him, because truthfully, it is literally the most frustrating thing ever. When someone's going, hello? You hear me? You hear me? Hello?
Justin, are you there?
Yeah.
Hello?
During the break, we were talking about how
I can hear you perfectly.
I know you can hear me perfectly. We were talking about how
What was that?
producer Matt can't is going to be not a talking head this episode because of two things. One, he didn't fix his green screen, so he's still missing half of his body basically. And two, he looks like he just got out of Snoop Dogg's tour bus. And I'll let that be.
I look okay. I've just been sick this week.
Oh,
You can hear it in my voice. I'm also a little doped up on meds.
well, that's good.
Meds. I guess that is considered meds.
Yeah.
I'm doing sober October.
Are you?
Yeah,
Interesting.
not drinking.
I bet I'll beat you.
I hope so.
I hope so too.
The ramifications of your sobriety are far greater than mine.
Oh man, I've been doing sober October for a long time now.
Good for you.
Oh man,
Good for you.
Like 5 Octobers now?
this will be my 6th October.
Hmm.
No, yeah, my 5th October.
Mhm.
I think something like that. How's it going? You're not having any wine? Like you're not like saying like, oh, I'm doing sober October, but like, I just won't get drunk. I'll just have a glass of wine.
No, nothing. You know what? That's not true. So, if my mom and dad come over for dinner, and my mom and dad are gonna have a glass of wine, I'll open a nice bottle of wine, and I'll pour like a little ounce or something in my glass, just to like cheers them. And
Right.
but that's it. That's like the only exception that like. So let's say it's
So Marcus's parents have moved in for October.
Yeah.
No, but like if my mom is having a glass of wine, it's so rare that she wants to have a glass of wine. And this weekend we had dinner together, and she was like, "I'll have a glass of wine." So I opened a nice bottle of wine and poured her a glass. And I didn't want to like her to be like, "Well, you're not going to have a glass." So I had a glass. A glass. I had a very small amount.
Right. And what did you have for dinner?
Fish. Like a nice sea bass.
Interesting. Is there a Greek word for it? Is it Papa the Papa?
No, it wasn't like a Greek fish. It was like, I would say more Asian, right? It was like a little bit of garlic and miso, and it was really tasty.
Interesting.
My mom loved it.
Yeah? I'm sure I would have loved it too,
Yeah,
but I wasn't invited.
have a look at you, pal.
We're actually doing Biggest Loser in the office with me and another guy. So we'll see. We'll announce the winner soon.
Yeah. Next up, we're going to do tallest midget.
Let's go to the questions. Matt, we had
In the land of the blind, the one-eyed man is king.
So we actually had a YouTube question come in, and in the comments, somebody had asked, is there such a thing as a 1-year mortgage? I didn't want to reply to them, so I just thought we'd jump into it on the show.
Yeah, there's 1 year's. There's up to 15-year mortgages in Canada. So, I mean, we get a lot of people from the States watching our show. So while you do whatever the hell you're doing over there, Justin, there is a 1-year product all the way up to a 15-year product. But in Canada, mortgages are partially amortized, which means that the liability or the responsibility to repay the mortgage is carved up into smaller time frames. And more typically, Canadians will take a 5-year product, whether it's a 5-year variable or a 5-year fixed. And then that product resets at the end of that 5-year term, which is why a lot of people are talking about the impact of the refinances that will have to take place or the maturities that will occur in the middle of this period of time. Because people are going to come out of a 5-year fixed rate where their interest rate was 2% or 2.5 on a 5-year fixed, and they could possibly be in a marketplace where the prevailing 5-year fixed rate is 5%. Now, the qualifying rate or the kind of stress test rate that we've had for all of these borrowers, which was, as far as I can remember, the lowest it's probably ever been has been like 4.5, should be helpful for them to qualify. But it most certainly will limit people's options. So it's going to affect how somebody can qualify for a mortgage with another provider. So think you're sitting out there right now. You've got a 5-year fixed rate. It's coming up for maturity in 12 months. That 5-year fixed rate that you have is 2.5. You're going to enter the market. In the next coming months, it's going to be higher than 2.5. If you don't qualify for that product, you're going to be essentially stuck with your existing lender.
Right.
And that is the time where you do want to reach out and speak to a mortgage broker. So even if you are 2 years out, a year out on a renewal that you know is impending, if you're worried about those ratios, speak to somebody now and prepare for it so that you have some optionality when that renewal comes. Don't sit waiting anxiously about where interest rates are, where they are going, and how you will qualify for that mortgage, because that is playing into the hands of your lender, right? Your lender wants you to not worry about things. Your lender wants you to sit back and just take orders from them as to, here's the rate we're offering you.
Of course.
And they do not want you to have options. Our job, the job of a good broker, is to make sure that the consumer has options.
Right.
And in a situation like this, where there is this level of uncertainty, the more time you can give yourself, the more options we're going to be able to give you.
Absolutely.
I don't know what the 1-year rate is, though.
So
I could just like bloviate about nonsense. But
you're looking at like probably about 469, 479, somewhere in that
okay.
area. So, yeah. I mean, talking about what we were just talking about, the inverted yield there, right? Like those shorter terms are going to be key.
Yeah. I mean,
Yeah, I would. 5-year fixed rates are just not an idea to take right now. Like,
Yeah, I don't think so.
we've been saying that for a while. I agree. I champion that statement. But if you are really, really worried,
Right.
I remember when I first started doing this, my mom and dad, like when I first started being a mortgage broker, my mom and dad had
Right after you quit Scotia.
Yeah. My mom and dad had like a $50,000 mortgage. And I was like, we should change this to a variable. Hotshot guy, like just became a mortgage broker. And I sat down with my mom and I was like, this is what we should do. I actually wanted her to refinance and pull money out so we could put it in mortgages and I could make them some income. And my dad was like, yeah, okay, that's cool. Let's do this. Like, my dad's always been, my biggest supporter. And my mom was like trying to go along with it. And then she just said like, I don't think I'll be able to sleep at night. And that put a nice perspective on things for me when I was dealing with clients, because it was like, okay, like there is a psychological aspect to this
100%.
that is very, very important.
Yeah.
Which another article I read recently, the psychological, like the depression that is happening because of the uncertainty in the markets.
Right.
For like the average consumer, the average borrower. And this is real. Like this is a real problem. Like the amount of, like we just came out of this, horrible period where people were worried about shaking hands with people and going into public spaces and where people were wearing masks. And we're entering into a new period where people are genuinely concerned that they will or will not be able to hold on to their assets.
Right.
And their debt load is increasing. And where is it going? Like, there's so much uncertainty. The United Nations came out yesterday and advised the central banks around the world to pause rate hikes. I'm not going to say that's unprecedented, but I think I might say that's unprecedented. Like, has the United Nations ever weighed in on monetary policy before? It just seems so strange.
Yeah.
But I think that if you're concerned for the well-being of the consumer, and like this is also a bit of a trickle down effect, right? Like, don't even just look at the Canadian or the American consumer. Like, developing nations are going to bear the brunt of this. So, where we're worried about, making payments on our mortgage, they're worried about having food to eat.
Right.
So I'll tell you, I will be much happier when there is a level of certainty on where interest rates are going to peak and where we think inflation is under control. I believe that within the next 6 months, we're going to have clarity on this.
Right.
And the consumer will emerge.
Yeah.
But I think that, and hopefully it's sooner, but I think we're still like in for a bit of a turbulent period.
Mm-hmm. Mm-hmm. Okay. Got a question here. You ready? Hey, Justin and Marcus, I've been trying to refinance the mortgage on my home so I could take out some equity for my renovations. I currently have a mortgage of $400,000 and my home is worth $900,000, but I've been having a hard time getting the additional money from my bank. They're giving me a hard time because I've taken some time off last year. Is there anything you can suggest that I do?
No rate, eh?
No rate. Not enough information. Yeah, next time. Well, first off, give us a shout, right? This person. But next time, just put the rate in. We'd be able to give you a little bit of a better definite answer. You know what I mean?
They have equity. So it's kind of like you're battling two things right now when you're looking to get a mortgage. You're battling uncertainty in the market.
Right.
So, in this case, this sounds like a candidate for a second mortgage or a home equity loan, depending on qualification, depending on the interest rate.
Mm-hmm.
We ran through that a little bit on the last show. We run through it on every show because it's so critical to the decision-making process for this. Like, you've got a mortgage, it's $400,000. Depending on what the interest rate on that mortgage is, will show whether or not you should break the mortgage to take a new mortgage to get money out, or you should borrow a second mortgage. In this case, time off work, probably can't qualify for the first.
Yeah, which is what a lot of people are going through right now.
Yeah, which means if you really need that money right now, it's a second.
Mm-hmm.
Because of that strong equity position, get the second now. Because if we continue through the next 6 months of this level of uncertainty, the equity in your home isn't bulletproof, right? That top line value of $900,000, we're seeing it more and more. Like, I noticed in the Monday morning meeting this week, a lot of the conversation around the deals that we have in our pipeline was centered around negotiating with appraisal companies.
Yeah.
To get values to where we think they're fair.
Right.
But understand that there's many stakeholders in this business, right?
Mm.
There's the realtor that sold you the place. There is the, mortgage broker that did your mortgage. There is the, appraiser that's going to appraise it. There is the lawyer that's going to close it. And each one of those stakeholders has their own dog in the race.
Mm-hmm.
And an appraiser in an uncertain environment like this, although their job is to look at comparable sales within a prescribed period of time, they're allowed to be nervous because an appraiser gives a value on a property and they write their name to it. And if there's a problem down the road, that value is relied upon by a lender, and that lender may no longer accept appraisals for that company.
Mm-hmm.
So my advice to you as a borrower is, if you really need that equity in order to qualify for the product, second mortgage or first mortgage that you're looking to do, you need to weigh the uncertainty of the market, meaning there is probably a little premium on second mortgages right now because of the uncertainty in the market, against the possibility of equity erosion in that the value might come off if you wait longer to get that valuation. I think we're reaching like a breaking point in that, where appraisers are kind of coming back into the market now and saying, like, you know what, this is the per square foot price of this. Haven't seen it trade this low since X date. I'm confident with this value, and I'm willing to put it forward.
Yeah.
But we could still see a further drop in real estate prices.
Out with the time adjustments.
Excuse me?
Time adjustments.
Right?
You know what I mean?
No.
Well, that's what's hurting us on appraisals right now. Like appraisers are going into houses and saying, well, for the next amount of time that this appraisal is valid, we've seen this percentage drop over the last couple months. So we're going to, carry that down the road for a few months, right?
Oh, yeah. Okay.
Yeah.
That's quite intelligent.
Yeah, that's what the real problem is.
Yeah.
Like, appraisals are coming in lower because, they're saying, oh, well, the market is falling, or the media is saying the market is falling, TREB numbers are down. In 3 months, this is what we think it's going to be worth. So we're going to tell you it's worth that now, right?
Yeah.
So.
Yeah, that's well said. So I think if you're looking for money right now, you got to weigh that. You got to weigh that you could get a lower value in the future, and a lower value in the future will definitely mean a higher interest rate or less money on whatever product you're looking to take. And you have to weigh that against maybe paying a little more right now, depending on how much competition there is for your loan. Like, again, you come to us for a second, we're going to do our best to do it within our fund, which means you're going to get a lower interest rate if we can do it through Connect, our mortgage investment fund. But if we can't qualify you for our mortgage investment fund, we go out and we try to get pricing from several players. And right now, because of the uncertainty in the market, that could be a little higher than even where we feel it should be.
Right.
But, and then that conversation, again, has to happen. Like, okay, we think your pricing that you're getting on this is a little higher because of this kind of risk adjustment that's playing out in the market right now. But if we wait, we might be subjected to getting less, or the value may come in lower, in which case pricing could be higher anyways.
Right.
Next one.
My mortgage is coming up for renewal in the next few months, which is both good and bad. I've heard interest rates are rising like crazy, so I'm a little scared about my monthly payment, of what my monthly payment is going to look like. But on the other hand, I was hoping to access some more equity in my home and pull out money for investments. My question is it the right time to do this now that I'm out of the contract with my bank, and can look elsewhere for my money? Or will the interest rate I get be too high to make significant returns on my investments? That's a good one.
This is a good question.
That's a good one.
Yeah, it was a smart person. So it depends on the time horizon of the investment that you're making. But if you have been, like, again, we spoke about the manic guy that shows up to trade stocks every day, depending on what this person is investing in.
GameStop.
Depending on what this person is investing in, this could make a lot of sense, but they should understand that their cost of capital for borrowing this from the equity in their home is going to be higher than it has been in the past. But the upside on buying into the market right now is significantly greater than what it has been.
Right.
So, if you're confident in the asset that you're investing in, and you believe that you're getting it at a significant discount, there's things that are trading at 50%, 60% discounts right now. There's blue chip stuff that's trading at 20, 25% discounts right now. So if you were acquiring those things before using the equity in your home, and you want to, average cost down those assets by buying now, there is a very strong argument to be had to state that the depressed value that you're buying these equities at today will more than make up for the increased cost of your capital.
Right.
But the critical piece here is you need to be able to budget that monthly payment, because you're going to be paying more depending on whether or not these investments that you're making are yielding something, right?
Right.
So like there's dividend
Investments,
yielding stocks right now that are spitting out 5-6% as a dividend yield, and also, based on historicals, show that you're going to get some capital appreciation. That's a pretty good candidate. Like refi your place, put money into one of these equities, get the dividend, to cover your payments and then enjoy the capital appreciation.
Mm-hmm.
The problem is are we confident that that 2-year yield is done moving? Are we confident that that US dollar index is done moving higher? No, right? So like that's the gamble you're making right now.
Mm-hmm.
You can own, like, again, on a long enough time horizon, everyone's a genius,
Mm-hmm. Mm-hmm.
right? You got a lot of time, buy.
Mm-hmm.
Depending on your time horizon, should affect that. And we are not investment advisors. We are mortgage brokers. So we can put you in touch with an investment advisor to help you analyze that time horizon.
Mhm.
And then we can work together, which we do all the time. Then we can work together with you and your investment advisor to identify the product that most closely fits your objectives, your timelines. But this is a holistic approach, right? In order to be unbiased, I guess I should say this differently. Being unbiased is like the price of admission into being good at this.
Mm-hmm. Yeah.
It's table stakes. What's really critical is information and listening.
Mm-hmm.
So understanding the questions you need to ask in order to provide the right unbiased information. Because you could be there sitting around giving everybody unbiased information all the time, but your information sucks
Mm-hmm.
because you don't know anything about the person you're advising.
Mm-hmm.
Right?
Yeah.
C'est tout.
I'm just thinking about table stakes.
You're a gambler?
No.
He's
Steak.
thinking steaks.
Or you're thinking about a steak?
Yeah.
That's how much he isn't a gambler.
I didn't know what. Well, now I understand table stakes. You know what I mean? But I'm not a gambler. I do kill it at the roulette table, though. There's something about me and the roulette table that we just get along. You know what I mean? I don't know.
Spoken like an imbecile.
Yeah. The house never wins with me.
Really?
No, that's not true.
Doesn't sound like it's true.
Oh, man. Okay, well, we're out of questions.
Mhm.
I had a really good time today.
And me too.
Did you?
Yeah, I always have a great time. doing this.
Yeah. It's nice. Now we're going to eat some of our sandwiches that we got from Forno Cultura.
Mhm.
And I'm going to go give some more unbiased advice to our clients.
Amazing.